Okay, thanks Jenny for the introduction. So I would like to start my presentation with a very short statement. It's called, no matter how small the decimal changes are, essentially they are very important. No matter how small the decimal places or how small is the percentage points, at the end of the day, you will see a result. So why do I say these statements? So just let me give you some of the examples that I have. So if you look at in healthcare, just a very small decimal changes in your prescription, that may cause an overdose in your patients or even results in fatality. If you look at aviation, a very small displacement in the autopilot systems, and you will end up in a wrong courier for your courier trip. And then if you look at for financing, just a very small decimal changes, just a very small percentage points, and you will see results, different results in your portfolio. So what we have recently seen just 2 weeks ago, roughly 2 weeks ago, is that there is just a very small, we can say it's a very small percentage points differences, changes in our OPR, overnight policy rates. We have seen Bank Negara Malaysia actually reduce the OPR from 3% to 2.75%. So why Bank Negara in Malaysia has actually made these changes is because they have cited the need to preemptively preserve Malaysia's economy. So that's like having an extra gift in your car booth, just in case that your girlfriend or wife gets angry. So that's the whole concept of why Bank Negara Malaysia has actually reduces OPR from 3% to 2.75%. And what we have seen in these 0.25% changes, what are the cascading effects, is that we have seen a change in lending rates, as well as a change in fixed FD's rates. So just in case that you have missed out on this news itself, we can see that from these slides alone, many banks have actually adjusted their lending rates, and most importantly, they have fixed deposit rates following this announcement, so that we can see big names, Maybank, Alliance Banks, basically most or all of them, they will adjust accordingly when OPR moves. So why is this the case? If you just look at how OPR actually affects fixed deposit rates, we can see that just a very simple banking 101. OPR rates means overnight policy rates, which essentially means bank overnight rates. So that means interbank overnight rates. So that means that if one bank lends from another bank, they will be lending at roughly 3% level. So when banks, their lending rates have actually changed from 3% to 2.75%, what we will see is that FD rates as a source of fundings to banks, they have actually reduces. So the overall attractiveness of fixed deposits rates as a source of fundings for banks, essentially they have just lowered. So we can see that there is a very high correlation between fixed deposit rates as well as the OPR rates. So that's why we have come up with the statements that when central bank moves, essentially your fixed deposit rates will move. I think you have experienced this yourself as well. I think most or all of us, we have been putting in FDs and we have been trying different instruments out. But ultimately, FDs, they rely on the OPR movements. So when OPR movement, the movements, they react adversely, your FD rates actually reacts adversely as well. So this basically makes me come to my very important concept for today. It's reinvestment risk. So just a very simple explanation of what reinvestment risk means is that the return that you are getting today might not be the same returns that you are getting from 1 year later or even decades later. Even if you are getting 3.8%, let's say you are getting 3.8% today in your FD rates. 12 months later, when your fixed deposits rates matures, when your FD matures later, at what level do you think your FD rates will be offered by the banks? It's probably not at 3.8% level again, but this depends on where the OPR rate stands at. So so if you just look at the picture itself, you can be very complacent or you can be very happy with the 3% rates that you are getting today. But remember, investment, you are not just looking at today or you are just not looking at 1 year later. You have to look at how long is your investment horizon is. Is it 1 year, 5 years, 10 years? You have to think about the rates that you will be consistently getting throughout all these years, throughout all these decades. And with that said, there is actually one way that you can consistently get a very consistent yield or a very consistent rates that you'll be getting. And the instrument is actually called MGS and MGII. So if you are first time listening about MGS and MGII, they are an acronym to Malaysian Government Securities, as well as an acronym to Malaysian Government Investment Issues. So basically, MGS and MGII, they are a source of funding for the government of Malaysia. So why do the government of Malaysia needs funding? Previously, decades, centuries ago, they might need this funding to fund for wars and all that. But today we don't have wars, but we need the funding for infrastructure purposes to build the bridges, to build all these infrastructures for foreigners to come invest in us and all that. So that's why Bank of Negara and Malaysia government, they actually issued Malaysia Government Securities as well as MGII. So if you look at Malaysia, MGS and MGII, they are fully backed by the government of Malaysia, since it's raised for the purpose of funding for infrastructure and all that. Essentially, they have the fiduciary duty to actually pay back investors at the end of the day. So if we just look at some of the features of MGS and MGI compared to fixed deposits, they have some very overlapping features, but MGS and MGI, they have some of the features that actually spice things up as well. So if we just look at some of the things, like they actually paid a very fixed coupon semi-annually. This is very, very similar with fixed deposits. You are getting not similar. You are getting a fixed coupon payment, just like your fixed deposits. And one thing that is good about MGS and MGII is that you can nit and pick. You can opt for different maturities based on your intention or based on your desire. So MGS and MGI, they typically issue between the years of from 3 to 30 years, different maturities for different investors' profile. And in essence, the last point that I have here is that MGS and MGI are essentially one of the safest MYR financial instruments that you can invest in. And just let me give you an example on why I do believe in so. So there is one very infamous case that I think most of us have heard throughout the years. It's called 1MDB. The very infamous stories, the very infamous scandals that is being made out by our previous governments. And if you look at how 1MDB has worked, what their intention initially is to raise funds and then invest overseas to gain capital appreciation, to gain money, to invest back in Malaysia. And what has 1MDB did in the past is that they have raised cash through bonds, 1MDB bonds, that up till now is still in circulation actually. Because 1MDB bonds, they have several funds that are maturing in 2039, so few years later. But even with all these scandals, even with people, even if when the legislation say that these things are wrong, 1MDB shouldn't, it's not for the benefits of the people, but ultimately it's being issued by the federal government back then. It's being issued by the federal government. So what the federal government today, they still need to pay off the debts that 1MDB has accrued back then. And they will have to pay it up until 2039 when the bond matures. So if you just look at this thing alone, no matter how the government changes from back then and maybe in the future, when a federal government, they borrow money, it's a fiduciary duty for the government to pay back, no matter who are the government parties. So if we look at another things about FDs, the differentiator between FDs and MGS MGII, one of the main differentiators between them is that the later, the MGS and MGII, they actually allows you to lock in the yield that you desired, the yield that are being offered today. But for FD, it's a little bit passive. When OPR moves, your FD rates move. So if you just look at this table alone, we can see that 12 months fixed deposit rates, the average that they are giving today is 3.38%. But some banks that are giving promo rates and all that, so it's just an average FD rates, 3.38%. But this is based on the OPR of 2.75% today. What if Bank Negara Malaysia opts to cut rate even further? What if they think that Malaysia economy might weaken in the future? They want to help preserve Malaysia economy. What if 2.5% becomes 2.25% and become 2%? This is a very important matter for investors to actually understand. When OPR moves, your FD rates moves, and it might not be in your favor. And hence why we do think that MGS and MGI, they offer you a way to actually lock in the yield that you desired today. And no matter how the OPR moves later, it's technically none of your business. You don't have to really, you don't have to worry about, when my FD matures in 12 months time, what the banks are going to offer me? 3%, should I accept it or how? So if you just look at a very simple example here, if you look at September 2030 alone, the yield to maturity is around 3.23%, might not be that attractive. But if you look at the longer dated ones, if we go to March 2046, they are offering at 3.81%. And if we even go for even further one, 2050, they are offering at 3.88%, which is even higher than what the general FD rates that you are getting today. But then you might ask me, going into such long duration, what are the risks that I have to bear at the end of the day? Yes, you do moves in terms of MGS and MGIU, they do moves, but as long as MGS and MGII, they are essentially backed by the government of Malaysia, unless that you don't invest in MIR currency bonds or MIR currency equities itself, we are all affected at the end of the day. So 2050 bonds or 2030 bonds, it's ultimately your choice. So that now that you might ask, if I buy 2050 bonds, do I have to hold until 2050? Technically, you don't have to, because Malaysia government bonds, they are very, very liquid. So if we just look at past historical data itself, MGS and MGI, they have been trading at tens of billions of ringgit equivalent. So we can see that with all these billions and billions of currency circulation, as well as trading, ongoing trading, There is no need to be scared that one day you might want to dispose your 2054 bonds, but you don't have a channel to do that. That's not a thing that we will have to worry about. So one of the things that MGS and MGI can offer that FD rates can't really offer to you. What the thing that actually spices things up is that MGS and MGI, they are more than just interest. You may incur potential capital gain or capital losses in the process. So let's just quickly go through how does this thing works. So let's say that you buy an MGS at 100 ringgit today, and it's yielding at 3.5%. And let's say that the OPR right now is 2.75%. But let's say that Malaysia government cuts rate to 2.50%. The yield on your bonds itself, the yield that is being offered in the market itself, they might drop to 3.20%. But remember that you have buy previously at 3.5%. So basically means that the bonds that you're holding on to, they are more attractive than what you're buying in the market when OPR cuts. So that this thing that actually reflect in the bond market price. So you can see that bond market price might actually rises to 102%, and you will have a capital gain there. So if you opt to sell off your bond, your MGS or MGI, when the OPR rate cut happens, you have actually a very modest capital gain right there. So, but conversely, if somehow Malaysia government or Bank Negara, they have opted to raise their interest rates, raise OPR, there might be an inverse capital losses. So that's how things work. So if we just let history speak for itself, if you just look at the last 7 OPR rate cuts, there are actually 5 instances when the yield have actually dropped, and consequently bond prices has increases. So, but then one disclaimer is that usually MGS or MGI or typically corporate bonds itself, they have moved earlier than what the market has predicted. So let's say that today OPR rate cuts by 0.25%, but usually the yield has moved earlier. So that's why we have pulled data based on 1 month before rate cuts and then 1 month after rate cuts. And history has shown that in 7 OPR rate cuts, there are 5 instances where you have fell. And we have also did a very simple calculation on our end. So let's say that you have buy MGS 2050 today, and there is a yield changes. Malaysia Bank Negara might cut their rates. Let's say that the yield drops by 25%, and you buy into MGS 2050 today. You will enjoy a 4% capital gain if yield drops by 25%, and you gain an extra 8% if the yield drops by 50% basis points. So it depends on what kind of MGS duration that you go for, and what are your beliefs, what are your convictions. So before things looks too rosy, we don't want to sell a story. We want to be factual. There are some of the risks that investors will need to understand. One of it is that, yes, there is the potential for capital gain, but at the end of the day, there might be a potential of capital losses as well. So, but based on what we believe in, OPR rate cuts would come eventually. 2.75 is actually at a higher range compared to average range. And that's why we don't see OPR rate hikes instead, but we are seeing that there are potentials for further OPR rate cuts, maybe 0.25%, but along the road, maybe another 0.25%. So capital loss risk, we still think that it's very minimal and it's very contained. Another thing that investors will have to note is that there is this thing called duration risk. It's slightly complicated, but what duration risk means is basically is that the longer the bond duration is, let's say the MGS 2050, it's more sensitive to the interest rate changes, let's say OPR. So that's why you will see a capital gain of a bigger capital gain when you buy into MGS 2050 compared to MGS 2030. So this is the two things that investors would have to be aware of. So this comes to our selection of some of the MGS bonds that we are offering in our platform. So you can see that September 2030 bonds, they are offering at a yield to maturity of 3.23%. If we go for longer one, June 2050, they're offering at 3.88%. So depends on if you think that FD rates would move in the future. If 3.88 is interesting to you, is attractive to you, lock in today, then, and you don't have to worry about how OPR moves and how your FD rates will be affected. So if we just quickly recap the whole things that I've shared, there are three key takeaways from my sharing. So one thing is that reinvestment risk is very real. Yes, OPR today is 2.75%, but 1 year down the road, when we gather together again at mid-year review 2026, will OPR still be at 2.75%? I don't think anyone can guarantee that. So be aware of reinvestment risk, understand your investment horizon, and understand what you want to achieve at the end of the day. And the second point that I would like to recap on is that MGS and MGI, they have the magic, they have the power to actually allow investors to lock in the yield, sometimes even for decades if you go for MGS 2050. That's approximately 25 years of yield lock-in. And then you might, and then the last point that I would like to highlight on is that MGS and MGI, they have this thing that FD can't offer, is that they are more than just interest. You might gain capital gain. You might gain capital gain if OPR rates actually decreases. Now it's 2.75. Where do you think OPR would be at maybe 1 year later or 2 years later? You would never know. So this is one of the ways for you to actually lock in the desired yield. And you can see if you want to lock in until 2030 or 2050, it's up to your discretion. So that comes to the end of my sharing today. So that's all for me. Thanks.